Hello, dear students. Let us understand about combined leverage in this session. So, leverage is basically the ability of utilizing sources to raise long-term funds. So, it is an essential topic in financial management. And this leverage, it has three classifications. One is operating leverage, financial leverage, and combined leverage. So, combined leverage is nothing but the combination of both operating as well as financial. Okay. So now we directly move on to the problem. A company has a sales of 1 lakh rupees and its variable cost is 40% of the sales, while the operating fixed operating cost amount to 30,000. The amount of interest on long-term debt is 10,000. You are required to calculate the composite leverage and it illustrates its impact if sales increase by 5%. So in this problem, we need to do two things. One is we need to calculate combined leverage or composite leverage. Both are same. So after calculating, identifying combined leverage, the same structure we need to do one more time and by changing the sales alone. So sales increases by 5%. If sales increase by 5%, what are all the changes again happen? Okay. So move on to the problem. So this is the structure. So again, sales, from sales is the origin, is the starting point, and the end point is EBT. Okay. So from sales to EBT, there is a format, there is a structure. So from sales, if we reduce variable cost, we'll be getting contribution. And from contribution, if we reduce fixed operating cost, we'll be getting EBIT. Okay, earnings before interest and taxes. And from that EBIT, again, if we reduce interest, we'll be getting EBT. So this is the structure. Okay. So sales, yes, it is given there in our question as 1 lakh rupees. See here, 1 lakh. So from the sales, we should reduce variable cost. So that is a format, right? Pro forma, right? So it is 40% of 1 lakh rupees. Okay, 40% of sales. See here, 40% of sales is given there. So 40% of 1 lakh, it is 40,000 is the variable cost. Okay. And which gives contribution. That is 60,000. 1 lakh minus 40. Again, from this contribution, there are two kinds of fixed cost. One is operating, another one is non-operating. Okay. See here, fixed cost is given here as, see here, it is 30,000, right? Fixed operating cost is 30,000. Directly, we are just writing that. And the answer will be, that is EBIT will be 30,000. 60 minus 30, 30,000. Again, from this EBIT, we should reduce interest. Is interest given there? Yes, the amount of interest on long-term debt is 10,000. So, just directly writing that 10,000 as interest. So, if we reduce this 10,000 from the before one, that is EBIT, we'll be getting EBT. That I will be cancelled, right? EBT, profit before or earnings before tax, as 20,000. Okay. So, from sales till EBT, so we got the values. So now what is the formula for composite or combined leverage? Contribution divided by EBIT. Okay. We started from, contribution sales till EBT. The entire thing, combination of both operating and fixed financial leverage is actually called as combined leverage. So its formula is contribution divided by EBT. That is 60,000 divided by 20,000. See here, 60,000 is the contribution, 20,000 is the EBT. So the answer is 3 times. So what is the meaning? If sales increases by 1 time, so EBT tends to increase by 3 times. Okay. So that is the meaning. So we got the answer for combined leverage. Now in our question, one more thing that we need to do. What happens if sales increases by 5%? You also need to do that. For that, see here, when sales increase by 5%, then what will happen? Same thing. So sales 1,05,000, right? See here, sales is 1,05,000. Sorry, sales is 1 lakh. So 1 lakh. So we should consider this 5%. So we'll be getting 1,05,000. Okay, now sales is 1,05,000 and rest of the things the same as the previous one, 40% of sales. So here you should consider sales as 1,05,000. Okay, so then variable cost will be 42,000. Contribution value will change everything. Okay, fixed operating cost, EBIT, its value it's 33,000. And again, minus 10,000 is interest. So now EBT will be 23,000. See here our EBT is 20,000. When sales increases by 5%, now EBT is 23,000. So here, so increase in percentage profits. Okay, so just for that calculation. So increase in profits divided by base profit into 100. This is the formula. So increase in profit. How much profit is what increased? First one 20, second one is 23,000. So 3,000, right? So 3,000 is the increase in profits divided by what is the base profit? Base profit is 20,000. Okay. So see here, the first profit that we received here is 20,000. Yes. So 3,000 divided by 20,000 into 100 as per the formula. So we calculated as 15%. So when sales increases by 5%, profit tends to increase by 15%. So that is the meaning. Okay. So two different answers that we identified using this problem. Okay. So this is the method of calculating combined leverage. Thank you all.